Hey, what's up guys? It's Steven. Welcome back to the channel. Now, if you've been watching real estate the last couple of years, you're very aware of the massive increase we've seen in real estate values. Now, part of this could probably be due to the decreasing in interest rates we saw out of COVID-19. But if you've been paying attention, you've noticed that in 2022, the Federal Reserve massively increased interest rates, which has led to articles like this from Redfin, where they're saying U.S. homeowners have lost $2.3 trillion in value since June. To put it in perspective, the US GDP is $23 trillion. So that's about the equivalent of 1/10 of the US GDP saying that we've lost in value. So in this video, I'd like to talk about how interest rates impact real estate values. So to start us off, let's talk about supply and demand. Now, I remember the first class I took in college. It was a macroeconomics class, and we talked extensively about supply and demand, to the point that we were pretty much blue in the face by the end of the semester. So to spare us from that, we'll just sum it up pretty quickly, where we have a downward sloping demand curve and an upward sloping supply curve. And where these intersect is the price discovery. That is, we have perfectly balanced supply with demand. At least that is in theory. And it works pretty well when you talk about commodities, which are just non-differentiated products. So think of corn. A corn farmer can't really produce that much better or different corn than his neighbor, right? Corn is, for the most part, corn. Corn farmers, of which I am one. I know there's a little bit more nuances to it, but generally that's how it works. And so in a real life application like that, supply and demand curves work pretty well to explain things pretty entirely. But when you get to a differentiated market, that of which real estate is, different things can happen. Moving on to the second point, let's talk about debt to income ratios. Debt to income ratios is just a fancy way of saying the amount of expenses you have going towards debt relative to the amount of income you have coming in. So for example, say you have $30,000 going to debt expenses in a year and you make $100,000 in income. Your debt to income ratio is 30%. That is, you're spending 30% of your earnings on debt. Now, a good debt to income ratio is pretty much below 35%. You can get a little bit above that, but once you get to like 45%, you're starting to get pretty heavily levered, at least relative to your income. And honestly, the first time I ever heard about this idea of debt to income ratios was when I went to get a loan on a house. I was looking for a conventional home loan, and conventional home loans operate off of this idea. So we've got supply and demand over here, and we've got debt to income ratios over here. Let's hold on to these as we move on to discussing the interconnection between interest rates and the price of real estate. And we'll come back to those and bring them all in together. So I think the best way to describe and talk about how interest rates and the price of real estate connect is through an example. So let's consider an example where somebody's going to borrow $250,000, and they're going to borrow it at an interest rate of 3.1% amortized over 30 years. Their monthly payment is going to be about $1,068. Not too shabby if you ask me. But let's see what happens then when we take it from 3.1% to 6.8%, which is a lot closer to what interest rates are today. All of a sudden, to borrow that $250,000 amortized over 30 years at 6.8%, the monthly payment goes to $1,600 a month. A nearly 60% increase in payments per month. Now here's where that debt to income ratio comes in. There might be a case where somebody's debt to income ratio maxed out at $1,100 a month. They simply just cannot take on any more debt and get into that $1,600 a month price range. They're just tapped out. So what's that mean? If they're capped out at paying $1,100 a month, their borrowing capacity just got shrunk massively. And in this case, it went from being able to borrow $250,000 to only being able to borrow $165,000, nearly $100,000 less, just to keep at that $1,100 per month payment. Now here's where we bring the supply and demand side back in. all of a sudden that person drops off or drops down on the demand side. So instead of having all this excess demand outstripping the supply that we have that just rockets and skyrockets prices up, all of a sudden we pull the demand back and we start leveling off the increases in prices. But the problem is, where we're at right now, is there's just no supply. And we can go into another level of this. And maybe this is where we should go with the conversation now, is that, yeah, we have the supply and demand curve that we talked about in my macroeconomic class back in college. And it was really easy and made sense with commodities. But when we start applying it to the housing industry that we're in today, the problem is that we might not be able to pull up, or people might not be able to afford the price that it would take to make it economically feasible to bring on new supply. And here's an example of that. I invest in workforce housing, multifamily apartment housing. Where I'm at, say workforce housing is affordable around $750 a month. And we're at full demand. Like, there is more demand in the market that we operate in than there is supply. So it would make sense to bring on more supply if we're going back to this supply-demand macroeconomic theory, right? Correct. But in reality, the problem is, if we wanted to buy or build and bring on more supply today, which is the only way to do it, it would cost us about $150 a square foot. So if I wanted to build a 2-bedroom, 1-bathroom apartment and make it a smaller one, only 750 square feet, at $150 a square foot, that would mean it would cost me around $112,000 per unit that we're building. To make it economically feasible for me to do as an investor, I would have to charge around $1,100 a month for that unit. Well, somebody who's in workforce housing paying $750 a month where we're at right now, that's starting to get to the upper end. I mean, they might be able to pay $850. Heck, they might even be able to pay $900. But to even go from $900 to $1,100 a month in our area for workforce housing is not feasible. So that is an interesting area where we're at right now with the supply-demand curves that we got going on, and the interest rates at where they're at right now make it very, very, very challenging to put enough supply back onto the market. So where do I think this is going? Here's where I think it's going in 2023. I think the Federal Reserve is going to continue to raise interest rates. This is going to continue to have this debt-to-income ratio pressure that we're seeing that's also flowing into the supply and demand. And meaning we're seeing prices come down. That's why we have the Redfin data that we just looked at. And I think that's going to continue. However, I think at least on the retail side, on residential housing, there isn't going to be a whole wave of new supply coming on because of the conversation we had about the cost versus what people can actually afford. The cost to build versus people's ability to afford. And that's not going to change anytime soon. The other whammy that we got going on, or that we have going on, is that people have locked in their interest rates at really low levels. So typically it takes 7 to 10 years for people to roll over and trade out of the mortgages that they have. But right now they have historically phenomenal debt. And so we might see a slower lag for more supply to come on to the market. So all in all, I would say that in 2023, on the residential housing side, I think we're going to continue to have very tight supply for the foreseeable future, assuming that the economy doesn't go completely to crap and people have to just sell their houses because they can't afford them anymore. That's at least my take. Let me know what yours is. If you like this video, I hope you like, share, and subscribe. It helps me grow. Leave a comment. Tell me how I did. Tell me what I can improve. And I hope to see you in the next one. Thanks.